So you heard in the video, there's two different types of life insurance, whole life and term life, okay? Whole life is designed for one thing really and one thing only, and that's your final expenses, because whether you're 22 or 92, somebody has to pay to bury you. Use whole life for this because whole life pays out 100% of the time. It pays out when you die, okay? Now, it also comes with cash value and paid up value, okay? If you kind of imagine a bucket here, every month you make your premium payment. This is your policy level right here. This is your face amount. Every month you make your premium payment, you're starting to build up cash in this policy. Down the road, many years, like 20 or 30 years down the road, you can borrow from this. You can take a loan against your policy. That's called your cash value. You can actually, at one point in your life, if you decide you want to, you can cash out your policy and take all the cash out of the policy that has accumulated in there, okay? Sometimes that may be more than what you've paid into it based on how long you've had the policy. That's called your cash value. You also have your paid up value. Let's say you paid this much cash into your policy. Again, this is your face value, but this much of it has paid off this much life insurance. That's your paid up value, your equity in your policy. You can stop paying on it. You can call the company and say, you know what, I don't want to pay on my policy anymore. I'll take my paid up value, and whatever level that's at, then you've got this much life insurance for the rest of your life that you never need to pay another dime on, okay? It's kind of like buying your house. Every month you make a payment on your home, you own a couple more bricks in your house, right? Whole life is the same way. Every month you make a payment into your whole life policy, you own a couple more bricks of your policy, okay? That's how whole life works. Now, term life is temporary insurance, okay? And this is all the insurance you get through work is term life, group term policy. Okay? Term life pays out approximately 1% of the time. It pays out if you die. Well, that's what makes it so cheap. Okay? A life insurance company knows that if I have for example purposes, if I have a $100,000 policy out here, and let's say it's a 10-year term, okay? I have 100 people who have this policy. They know in the next 10 years, only one out of that 100 is going to die. So you can take this $100,000, divide it by the 100 people, divide it by the 10 years, much cheaper policy. The only family that financially benefits from this policy, though, is the family of this individual here who passed away. The other 99 do not financially benefit from the policy. But do they benefit from the policy? Absolutely. They have peace of mind during all those years to where if something did happen to that person, they have protection, okay? Term, because again, it's temporary insurance, you use it to protect temporary expenses in our life. What are our temporary expenses? Our first temporary expenses are income. We only need to protect our income during our working years. Once we retire, we no longer need to protect that. We need to protect our mortgage with term. If we died, our spouse's number one concern is, how am I going to pay my mortgage without my income? You only need to pay on that or have that protection while you own your house. Once your house is paid off, you no longer need that. And kids' college education. Again, we want to make sure our children can go to college if that's what they choose to do. And if we're not here to provide that, we want to make sure the protection is there to do that. Again, once our kids are grown, we no longer need that protection. So these are all temporary expenses, and we use temporary insurance. Now, if you imagine that same bucket, every month you pay into the bucket, just like your car insurance, what does that money do? It goes right out the bottom of the bucket. You can pay on your current car insurance for the next 20, 30, 40 years. If you never have an accident, can you go to your car insurance agent and say, hey, look, I've never had an accident, I've never utilized my insurance, I'd like all my money back. What's he going to say? He's going to laugh at you, right? There's no way. Why? Because you're renting your insurance. Renting your insurance is just like renting your house. You can rent a house for 30 years. At the end of that 30-year period, how much of that house do you own? None, okay? Term insurance works exactly like your car insurance and exactly like renting a home. You only have it while you're paying on it, okay? So if you, a normal life, let's say you're 30 years old. In a normal life, we have our normal lifespan, okay? Let's say you picked up a $100,000 policy at the age of 30. Whatever the price of that policy is at the age of 30, it'll be the same price at the age of 40. It'll be the same price at the age of 50, same price at the age of 60, 70, 80, okay? And the average lifespan is 85 years old, okay? Your whole life policy will never go up or down in value, and it will never change in price. It's locked in. But it comes with a couple different options. What do we all want to do at the age of 65?
Retire.
That's right. So when we retire, what happens to our income? It decreases, correct? So what do we naturally want? We want our expenses to decrease at the same time. So whole life gives you a couple different options. First of all, whatever you're paying for way back here when you're 30, by the time you're 65, isn't going to be considered that much money. So you could afford to continue to pay on it if you want to, and you have the full face value of your policy. Make sense? Or you can say, you know what? I've done so well in my life, I don't need life insurance anymore. I want to cash my policy out. So you can take all your policy, because you got it when you're so young, and this is just for example purposes. Let's say you paid $30,000 into it by the time you're 65. The cash value is $35,000. You can say, I don't want to pay on it anymore. I want all my money back. In this case, we would actually give you a little bit of interest on top of it. So you got every penny you ever put into it back, okay? Or you could say, maybe I paid $30,000 into it, but by the time I'm 65, $75,000 of it is paid off. That's my paid up value. I want to stop paying on it, and now I have $75,000 of life insurance for the rest of my life that I never need to pay another dime on. Make sense? Do you understand whole life? Okay? Now that same term life policy at the age of 30, that same $100,000 term life policy is going to be way down here. Much cheaper in price. It's locked in for 10 years. But then 10 years from now, it's going to renew, and it's going to go up in price, okay? And it'll be locked there for another 10 years. And then it's going to go up in price again. And then it's going to be locked in there for another 10 years. And then it's going to go up in price again. And then when it hits that magical age of 65, every 10 years it's going to go up in price, okay? And when it hits that magical age of 65, it's going to go away. One of two things is going to happen. This price is either going to become so high that you cannot afford it, or it is written into the policy that after the age of 65, it literally goes away. So either way, typically at the age of 65, your term coverage is lost. Does that make sense? Okay. Now, in a normal life, this is our life arc, okay? You grow up, you get married, you have some kids, you buy a house, you hit your peak earning period. Your kids grow up, your house gets paid off, you retire. This is your need for term going up. This is your need for term going down. The only constant we have in our life is our need for whole life. Because again, whether you're 22 or 92, somebody has to pay to bury you, okay? Now, where a lot of people make the mistake is right here in their life, when their term goes away, they say, hey, I need to pick up some whole life, because they didn't realize their term was going away. And they try to pick up whole life at this age in their life, and it's either one of two things. It's either very, very expensive and they probably can't afford it, or they're medically unqualified. So the way we feel is that everybody at this point in our life should have a combination of term and whole life to make sure our family is fully protected for their lifetime. Does that make sense? Okay, good.